Fitch's Fixed Interest podcast delivers the analyst insights and updates you need to stay ahead in a rapidly evolving market. From global macroeconomic trends to sovereign credit developments to regulatory and political changes.
Welcome to Fitch Ratings Fixed Interest podcast. My name is Justin Patrie. Our topic today is a big one: AI and what its disruptive effects could mean for the credit profiles of big tech and other sectors too. And joining me for this discussion are Alen Lin, Senior Director in our technology team, and Alex Bumazhny, a Group Credit Officer and Senior Director in Fitch's Risk Department. Okay, Alen, let's start with you. One key aspect of AI that's under a lot of focus right now is the enormous level of capital investment going into the sector, especially for the build-out of data centers. And you recently took a fairly deep dive into this in a report titled The AI Build-Out Value Chain. What were your key findings? What did you find out?
Sure. Yeah. So like you said, right, I mean, over the last couple of years, large language models have really taken off, right? Started from ChatGPT a little over 2 years ago, and now, I think most of us have tried it, to some degree. What this translates to is that there's a lot of compute that's needed to actually drive all these large language models. And this, as you mentioned, right, Capex headline numbers look big for 2026, right? We're talking about, across the industry, $650 billion. And, this doesn't include China, because we exclude China because that's really a separate ecosystem we consider. But just, within the addressable market of the US AI companies, right, it's over $700 billion. And this kind of, goes into different pockets of the subsystem. IT equipment, right? That's a big chunk of it, right? And you have a lot of data center being built out, and the power supply that's needed, right? And just tangentially, right? You see chip financing, you see data center financing, all happening. So how do we, capture all this, right? This is where we kind of break it down into kind of taking a holistic approach to look at the entire value chain, right? There are obviously different layers of the value chain where value is being created. So if you kind of think through a value chain, right, at the top of the value chain, in this case, is really your power supply, your data center, the kind of shell of the data center, the IT equipment, right, a lot of GPU, AI accelerator. We kind of consider this as the subsystems of the AI infrastructure. Now, you go down one layer from there, right? You have the AI compute layer. That's where all these subsystems come together. They're integrated so that they can provide compute capacity. And then the compute capacity ultimately, right, flows down one layer lower to the AI service providers. This is where you see the Microsoft Copilot, Google Gemini, and your OpenAI, ChatGPT, Anthropic, xAI. All these guys are pretty essentially considered service providers. And then from there, right, the services go to the end users. We roughly break out these into three buckets. There's the direct consumer, right? I think some of us have exposure to that. Paying $20 per month to get ChatGPT. And there's the enterprise bucket, where we think this is mostly going to be from productivity gains by corporations. And then there's a third bucket, right? At some point, some of these AI features can be added to existing products, and incremental revenue can be generated from this type of AI services. So this is, how we kind of think about the entire ecosystem, is through this value chain, right? From subsystem all the way through the end users. Now, if you, flip this around, right, going from the bottom of the chain to the top of the chain, this is how the revenue is going to flow into this ecosystem and ultimately pay for all the capex, the $650 billion we mentioned earlier. So, again, going back to kind of the three buckets of end users that we thought about, right, consumers, enterprise, and embedded AI. We have to arrive at some kind of estimation of what we think the revenue generation can be a few years from now, right? Obviously, today there's not enough revenue generated But there's a lot of capex going to the ecosystem to provide all this compute capacity. But at some point, right, that revenue generation needs to happen. So we take a view of by 2030, right? What does the market look like? So if you kind of think about of these three buckets of end users, right? Who's going to be the biggest contributor into this AI ecosystem? Consumers are, the ones that started paying early, but these are mostly early adopters. We don't think that's going to be the bucket that's going to drive long-term growth. Where we think the biggest potential is in the enterprise bucket, productivity gains. So we took the approach, took a step at how to estimate this. So we end up using the S&P 1500 data set, which contains some 90% of U.S. public companies. We look at all the operating expenses for all these companies, and we use that as a proxy, right? So of all the OPEX companies spend in their daily operations, how much do we think they will spend on AI in 5 years? So we went effectively sector by sector, looking at the entire universe within the S&P 1500, and started with a baseline of 5% of OPEX that they could spend on AI services. There are some industries that we thought could be 10% or 15%, and there's one industry, software, we think they could spend 20% of OPEX on AI. So once we make these assumptions and aggregate the entire S&P 1500 universe, we arrive at about 8.4% of OPEX could be spent on AI services by 2030. So within the enterprise bucket, right, by taking this approach, making an estimation, it gets us to about somewhere between 500 to 700 billion of AI spending that's possible by 2030. And then we also use that same data set. We try to understand whether incremental revenue opportunities exist in the embedded AI bucket. So kind of similar approach, right? We went through industry by industry, made assumptions of, whether we believe revenues can be generated from AI services, and we're more reserved in this bucket. I think for most industries, we assume there's no incremental revenue, but there are some that have the potential. So we kind of bucket them into 1%, 2%, 3% of revenue that they can generate, and that gets us to about 300 billion to about 450 billion. So those are the two major buckets that we think will drive growth in the next few years. Now, back to the consumer segment, right? Yeah, there were the early adopters, but we think the upside potential is capped. So that's probably in the range of 25 to 120 billion that we think will come from consumers, and that's roughly pretty similar to what we see across the software space today. So if you aggregate all these three buckets, right, you end up getting to about 800 billion to 1.4 trillion range. Midpoint, let's say about 1 trillion to 1.1 trillion. So this is the amount of revenue that's available to go up to service providers, and then going up further to what to pay for all these AI compute cloud Capex. So with this estimation, it gets us to a Capex number that's sustainable at about 430 billion to 698 billion. Now, earlier, I did mention that industry is spending about 650 billion, right? Now, this total capex. So we do have to back out what is non-capex versus what's really capex that's being spent, and roughly 150 to 200 billion we believe is not AI related. So you end up with about 450 to 500 billion. That's really being spent on AI capex. So compare that to the number I just mentioned earlier, through this value chain analysis, 430 to 700. I think the current spending of 450 to 500 is actually kind of right in the midpoint of where the spending should be based on the market opportunities.
Yeah. So the bottom line is that the Capex levels you're seeing seems to be justified by future revenue potential. But, what happens in the event that the future revenue potential is kind of lower than the estimates that you identified through your deep analysis? How does financial stress play out in the ecosystem in the event of perhaps a downside scenario, 20%, 10%, whatever you want to call it?
Well, we hope that doesn't happen, but being credit analysts, we do have to think about, what if the revenue potential does not materialize into real revenue? And, we kind of working through this value chain again, going from the bottom, right? Effectively, you're not monetizing sufficiently from the end users. So the first layer is going to hit is going to be AI service providers. We do want to kind of segregate, right? You do have what we call vertically integrated service providers, right? They are the ones that basically occupy the entire value chain. Those are the Microsoft, the Google, the Meta, and then you have kind of the independent AI service providers like OpenAI, Anthropic, and xAI. So I think the independent ones are the ones that could be more vulnerable, right? Because their entire business depends on AI being successful. The vertically integrated ones, right? They have other businesses that can subsidize and cover the expenses of AI services. So we kind of really the risk is really on the independent service provider side, and what they will have to do is they need to have continued access to external funding, which what they're doing today, right? If you look at all these independent AI providers, they're not profit generating, right? So they all depend on some external funding, mostly through investors. But perhaps that external funding runs out, right? So the stress is going to flow upwards towards the AI compute cloud. There are a lot of the capacity being built, right? For example, right, your CoreWeave, your Lambda, Oracle, they are in multi-year service agreements with the AI service providers. In most cases, 5 years, right? But in the event that the one of these service providers not able to actually fulfill its 5-year commitment, there's going to be a shortfall with the compute cloud providers. They already spent the capex, but the revenue is going to come in short. This this current stage of where the industry is right now, I believe that's kind of where the focus of the stress could be, right? Again, it's money already spent, compute capacity in the ground, but I'm not getting enough revenue to actually pay for all the equipment on the ground. Again, within this category, the AI compute cloud providers, right? You do have the vertically integrated ones, and you have the independent ones. And I think the stress is going to be more centered around the independent compute cloud providers. Now, this is where we have to really pay attention to what the counterparty risks are, right? Because their customers, the AI service providers, right? Some of them are very strong, right? Like Microsoft, and others like the independent service providers, OpenAI, Anthropic. Quite some of them fail, right? So this is where we have to think about within the AI compute cloud, what is exposure to the riskier customers versus the stronger customers. Now, so at the AI compute cloud layer, right? There's going to be some dispersion in terms of exposure to risk. Now, if any of these guys fail, right, then you have to kind of go up one more layer, right, among these subsystems. And the one that we're more concerned about is the data center with 15-20-year leases in general. Are they going to be able to find substitute customers to actually take over those 15-20-year leases? Now, it is a riskier we look at, But at the same time, right, in order to get to the data centers, right, there has to be multiple layers of failures to actually for those leads to be broken, right. So I think the more immediate, right, is really the AI compute cloud layer, where the Capex, the real money, is being spent, and hoping that revenue will materialize.
Thank you very much, Alen. So let's turn to Alex. You also recently led an AI-related report looking at the implications of the rise of AI, but focusing on corporate issuers beyond the tech hyperscalers. And you were focusing on overinvestment and disruption risk. So let's start with that overinvestment risk. What did you find out? What were some of the sectors that you felt there was some material exposure?
Thanks, Justin. Yeah, hyperscalers and cloud computing providers were definitely top of our list as far as sectors with potential issues to look out for, as far as overinvestment is concerned. So I'm not going to spend too much time there because Alen spent a decent amount of time discussing that already. The other sector that was also made the list for us as far as higher exposure to overinvestment is semiconductors. So you're talking about a company like Broadcom and Marvell. These companies make ASIC chips. There's also companies that make the GPUs for the data centers as well. And right now they're doing pretty well. Revenues are skyrocketing for these companies as they're providing these chips, and the demand is pretty high. But these companies also don't make their own chips. They outsource it to TSMC. So the risk is not so much on the Capex and that they'll invest in too many factories or anything like that. It's more that their revenues are currently at the peak potentially. And what happens if there's a slowdown in demand and all of a sudden the revenue and EBITDA declines and their credit metrics start not looking as great. Fortunately, these companies typically operate with balance sheets that are designed for this kind of thing in terms of cyclicality and different build-out cycles. So even if things do turn down, which we do expect at some point things will moderate, these companies are in decent shape to handle that. And also we flagged several other sectors that we marked as medium risk in terms of overinvestment. So these include companies like sectors like industrials, utilities, also digital REITs. So these companies do also partake in the ecosystem. So for example, industrial companies will make the turbines that go into power generating plants that power the data centers, and there's a bottleneck at many of these levels. But the good thing again is that these the issuers in these sectors are being pretty prudent with their capital allocation, so they're not rushing to go out and build a whole bunch of capacity and stretch their balance sheets. They're taking more of a stepwise approach and being pretty prudent. So we're not seeing too much concern on that front.
And now let's turn our attention to disruption risk. So which at-risk sectors did you identify from AI disruption?
Yeah, disruption risk, probably more acute risk as far as credit story is concerned. And this is probably more of a medium-term risk. So at this point, we're marked sectors, media, services, and software as the three sectors that we see higher risk relative to other sectors. And what these sectors have in common is that they all have pretty low physical assets. They really rely on human capital. They also rely on intellectual property. And these are the kind of things that could potentially be disrupted by AI solutions and potential new competitors that are leveraging AI to create a product that may be deemed good enough to compete. And that what would that do is if that enters the picture, that could potentially put pressure on prices, on margins, and ultimately on the credit picture of these three sectors.
Thank you. And I have a final question for both yourself and Alen. So a lot of AI analysis is really looking out beyond sort of a 3-4 year time horizon, including our own in these recent reports that you published. So if you had to kind of identify kind of one thing, is there an indicator, an event, a trend, what would kind of one big thing you're looking out for that would maybe cause you to adjust your 3, 4, 5 year expectations, be it a risk, either upside or downside? what's sort of one or two key things that you're looking at that could have a material effect on your 4 or 5 year forecasts and assumptions? So let's start with Alen.
Yeah. So, as we identify in our value chain analysis, right, the biggest bucket of revenue driver needs to come from enterprise, right? We need to start to see uptake in AI adoption across all the enterprise, large or small, medium. I think that's one indicator we do look at. We even look internally, right, looking at ourselves, Fitch, right? Are we using AI to a point that we have to be start to actually count the number of tokens that we're using from these AI service providers. So that's one indicator. Is more qualitative. Now the second indicator is a bit more quantitative, right? We don't get a lot of visibility into these AI service providers, how much revenue they're generating, but they do speak at conferences. They do talk about their expectations. For example, right, we look at OpenAI, right? They exit 2025 at about $20 billion revenue run rate. Where do they need to be for all this, the whole value chain to actually make sense? By 2030, right, we believe they need to be north of $150 billion in revenue. So that's something we're tracking very closely, right? If they start to fall behind over the next 3-4 years in getting that 20 billion, moving that towards 150 billion, we need to be concerned, right? Now there's the other scenario, right? They could actually overachieve that goalpost. Yeah. So those are the key things that we're tracking. One is just looking at across the different companies, different industries, right? How is AI being adopted? Number two is the revenue starting to materialize.
Thank you, Alen. Alex, anything to add to that?
Yeah, it's really difficult because it's hard to parse out exactly what's impacting the performance of our issuers, whether it's some kind of macro or a competitive risk that's not really related to AI versus AI directly. I think what would give me concern and be more alarm potentially down the road is if you actually see more explicitly competitors that are strictly AI driven come in and start actually taking market share, and you could start seeing market share erode of our issuers. I think that would be kind of a sign that things are really shifting.
Thank you very much, Alex and Alen. And thank you, as always, to our listeners and viewers. If you'd like to learn more about Fitch Ratings analysis and views, please visit fitchratings.com. And make sure to also subscribe to us on Spotify or Apple.
Subscribe to Fixed Interests wherever you get your podcasts.